I think we are ready to toss across to the HCL Tech Management. Reema caught up with the HCL Tech Management after the release of their Q3 numbers. She began by asking them about the key drivers behind the stellar performance. Let's go across.
I would say the environment always has been friendly so far as we are concerned. It's a matter of having the right service offerings. So HCL has always created a balanced portfolio of services. It's something which can lead to a long-term momentum. So we are in the momentum markets of ITO, we are in the momentum markets of digitalization, and we are now in the another momentum, could turn out to be a momentum market of engineering and R&D services. So if you look at, we reported 6.2% quarter-on-quarter growth and 16.2% Y-on-Y growth. And not only is the growth in revenues, but also growth in the net income at 7% quarter-on-quarter, 27% year-on-year.
Correct. So my question is, why couldn't you deliver this 6% constant currency growth in the previous quarter? So what was so different in this?
Sure. So as we have been announcing a lot of deals, and those deal wins are always accompanied by a transition, transformation, and then getting into a steady state. Some of those deals, we completed the transition and then they moved into the steady state. We have been saying that it's because the deal tenures are becoming longer, deals are becoming complex, the sizes are becoming larger. So it takes time to sort of do the transition and transformation and then start recognizing the revenues. So this quarter we had the benefit of those deals coming, where we were working on transition and transformations coming into steady state this quarter. On top of it, we could also add the engineering and R&D services. We had good wins. We have been saying that we are winning the engineering and R&D services deals, which are end-to-end, where we are adding a lot of value to our customers, which could be on the product lifecycle management. So those deals again helped us to enhance our revenues. So both, and then together with the application services and a lot of verticals, I mean all verticals practically, aided that growth in this particular quarter.
So would you like to caution us from expecting the same kind of a performance in the coming few quarters, perhaps in any geography, vertical or service line?
Well, I mean,
were there any one-offs which perhaps may not be there in the next quarter?
So first of all, there is no one-off here. It's all business as usual. I mean, I would call it. There's all organic revenues, no non-organic element. We haven't done any acquisition where we are recognizing the revenues, and there's no one-offs. So there's absolutely a business as usual. In that business as usual, as I said, you can't, in a ITO deal or engineering deal, you can't start looking at the revenues from a quarterly perspective. You have to look at from a longish perspective, longer perspective. Okay. Typical period is like 4 quarters you look at. That's a typical period. So our business will continue to be like that.
Okay. Steve, let me come to you on engineering, because that seems to be the new momentum vertical for the company. And even the last time I remember, Mr. Chanana was telling us how this is the vertical which perhaps is at an inflection point, similar to what infrastructure was in 2007. And you've delivered fabulous numbers, 12.5% this quarter, 8% in the previous quarter. Give us a few numbers to tell us the kind of opportunity is there in infrastructure, the kind of deal wins that you've seen, the size of the deals.
Yeah, so there's 2 things that we've seen as emerging in that market. So for us in the past, mostly clients gave us a component of their service offering. We're seeing for the first time end-to-end services being contracted in engineering. So it's a first-time outsourcing market where we take those on, we're taking on client personnel and moving them over. So this is very much outsourcing, but in a different part of a client's organization. And then the second thing we see is digital platforms. So our application business does a lot of the digital design, but actually engineering is there to build platforms end-to-end. So those 2 trends are giving us momentum. And as Anil says, what we're looking to see is that some one-off deals that are marking out a new market for us, or are they just one-off deals? And so we're watching that closely.
So are you convinced whether this is a one-off or it's emerging as the new outsourcing?
So we've seen it quite consistently now over the last 3-4 quarters. Deals coming to the market that are quite a different shape to what we've seen before in their end-to-end nature. So we're optimistic on that, but we're watching the space. Okay.
Mr. Singh, let me come to you in the financial space. Most of the verticals have done well, but finance is moderated on a quarter-on-quarter basis, and plus the company's, the vertical's growth rate is lower than that of the company average. What was the reason?
You know, actually the way you should look at financial services performance for this quarter is you should look at last 4 quarters. Okay. And if you look at the 2014 full year performance, I think we grew financial services almost 22.6%. 22.6% was higher than most of our peers. So if you look at our peers across the spectrum, financial services growth rate has been in the in the teens.
So we shouldn't read too much that in Q3 and Q4 your growth was at 6 to 8% in financial services, but in the last quarter it moderated to 3%, and now it's down to 1.6% in constant currency.
Yes, so if you look at it on an average basis across the last 4 quarters, it's like 4% on an average across the 4 quarters. So it's an aberration. That's the way we look at it. And as Anil mentioned, you know, it's a sustainable business model. We are looking at new customer acquisitions. Customer acquisitions happen, you know, then the ramp-ups happen and so on and so forth. So it's more appropriate to look at it on a 4-quarter basis.
No headwinds.
The headwinds that financial services is seeing is largely to do with currency, and that is something which we see both as an opportunity and a risk. The opportunity for us is that our financial services business tends to be dominated in Europe, UK, Australia, some of the places where the currency has weakened substantially.
The cross currency.
So we've got currency headwinds there. Having said that, since these markets are under turmoil, financial service industry specifically is under a lot of pressure in terms of cost. So it's an opportunity for us as well, because our large presence in these geographies positions us well to take advantage of the little bit of turmoil happening in the financial services sector.
Okay. Mr. Chanana, let me come to you on margins. You know, the company has been consistently maintaining margins in the 24%. It's demonstrated an ability to even absorb wage hikes. Is this, 23-24% margin range sustainable for the next few quarters as you see it?
I would say our internal goal, which we have set for ourselves, is 21 to 22%.
But you left that far behind many quarters, ago.
I mean, all our investment, if you look at this quarter, sales and marketing has gone up by 15% quarter on quarter. If you look at G&A spend has gone up by 7%. A lot of leadership hiring, a lot of new setup, including in Cary, we are setting up a facility.
But despite
we
that,
are all that
demonstrated the ability to maintain margins.
Well, as I said, this quarter, because of the significant revenue growth it sort of helped in the margins. It could flow down.
Okay. Steve, let me come to you on infrastructure, because that's the mainstay of growth. It's been the growth driver for HCL Technology, but the performance has been a bit volatile. It used to grow at 9%, it came down to 5%, then 3%, and this quarter has bounced back.
Yeah.
How should we read the IMS service line for the next few quarters?
So I think a similar comment to Rahul making with it. We win large deals in the infrastructure space. They have a transition and a steady state situation. But I think if you take the overall view, we grew 22% last year in infrastructure. I think the combination of infrastructure growing strongly and our non-infrastructure services growing strongly is why you see such a strong performance overall. So both did well. And in absolute terms, we added $350 million of incremental revenue in the last 12 months. Way above any of our competitors. So we view ourselves still as the market leader in that space and continue to see strong deal flow.
Okay. And what about in your core IT business or applications? There too you've witnessed a bounce back in the company's performance. It's the best that at least I've seen in the last few quarters.
Yeah.
Any numbers over there to tell us that this momentum might sustain?
Yes, I think in that market you've got a headwind and a tailwind. So what we battle against is a decline in the traditional build services. People aren't putting in new ERP systems anymore. That's been replaced by software as a service and cloud offerings. And so what we've seen is that's given us muted performance. But the tailwind that we have is digitization, so emerging services. And what we're starting to see now is that those new services are outweighing the traditional services.